Right?
That was when it was. Like I said, March of 2000. It was boom, first $1 trillion company, and then never to be seen again.
Yeah. Never
Even
good
though
again.
Even though they sell more now
they
than
got
they
more
did then.
employees now. They got way more sales and make way more profits. It just the growth went from we're going to double, we're only going up 20% next year. Oh, you're garbage, threw you out,
Yeah.
and it got flushed with the rest of the .com stuff for sure, but. Yeah.
Well, they're going to have to
But it's
continue to
happening.
develop the chips, right? They're at the AI front with the chip, just like it was with the graphic cards. There has to be an evolution to their product over time if they're going to continue to grow, because at some point the market gets saturated. It has all their chips, and so it's either you're going to have to keep making bigger, better, newer chips that have that demand, and so you're going to have to stay ahead of all your competition to have that level of growth.
That's so one thing. I'm actually going to try to pull that chart back up on the market cap, and this kind of ties back. That's a good comment, tying it back to, let's say, Apple Computer. And so if I bet all of us right now would not get this right. We all have our iPhones in our pocket or in our office or whatever. Do any of you know exactly what iPhone series you have?
What do you mean?
13, 14, 15?
I do, because I have the oldest one in my household. We had this discussion this weekend.
Yeah.
I don't.
Yeah. You do lose track. I have to look it up. I just happened to look mine up.
Because there's no difference anymore, right? Other than the camera's a little bit better, the battery's a little bit longer, but your motivation to go stand in line is not what it used to be when iPhones first came out. And so now you can look at Apple's market cap going back 3 years, it's dead flat. Because to Kyle's point, unless you're innovating and you're making a brand new product that people want,
Yes,
it's like, what's the motivation to buy it? So that's going to be NVIDIA's challenge. Now, right now, their advantage is they just came out with this brand new H100 chip that everybody wants, but it's the greatest thing out there. And again, until it's not, but they've got the capital now. They're doing the R&D for the H200 chip.
Oh, yeah.
You know what I mean? And
Absolutely.
that's probably going to still be more advanced than, AMD or someone else nipping in the heel. So I think they've got a moat for a while, but so did Apple. You
Yes.
know what I mean?
Yeah.
And until they get saturated in the market.
So I just pulled it up. Cisco, we might have to strike this from the podcast, and I don't care if we do, because this is the truth. It was $80 a share in March of 2000, corrected for splits and everything else. It's at 46 now. It's about half of what it was at its very top when it was selling at that kind of price to sales and all that stuff.
And that goes back to
and they make way more money now as a company, profitable. They're making way more than they were making in 2000.
It's expectations. I mean, you can take another name that was on there that was hot for a while, was Tesla. Now they're selling way more cars now than they were 5 years ago, but the stock is half the price of where it was because people are all expecting that ski slope. And when is it going to roll over?
Yeah,
that's a single stock risk too. If you bought Cisco back then, you have less money today after 25 years. So
yeah, and we're not talking about it. It didn't like. It just happens to be back down now. It's the highest it got back to was looks like $63. Yeah, corrected for splits, $80 in March of 2000, and
was
just
it
went
worth
through
$1
this
trillion at 1 second?
Yeah,
right?
that was when it was. Like I said, March of 2000. It was boom, first $1 trillion company, and then never to be seen again.
Yeah,
even though
they sell more now than
they got
they
more
did then.
employees now. They got way more sales and make way more profits. It just the growth went from we're going to double, we're only going up 20% next year. Oh, you're garbage, threw you out, and it got flushed with the rest of the .com stuff for sure. But it was it was viable and a really good company. So it's really crazy how some of those happen. And I mean, Coca-Cola. Look at Pfizer right now. I mean, Pfizer's really, the stock itself is really struggling. I would guess without looking, the company's probably making just as much money. But the growth expectations go away, and immediately all the foam is gone off the top.
Yep.
So you got the company like NVIDIA or Tesla or whatever. They just have to. It has to be perfect. They have to execute perfectly,
innovating.
and they can't, it's almost impossible to do. Like nobody's ever done it. And it's shocking how fast some of these, I mean, NVIDIA has gone up in terms of value. I mean, it's up another, 50, 60% this year so far.
Well, we hit on a previous podcast too. It's
crazy.
It's going up in the face of rising interest rates, right?
Right.
So historically, tech doesn't do that, right? So we expect with rising interest rates, the Nasdaq to come down a little bit or give up some of that, and it's still gone straight up. So
the hard part is and you said this earlier, when you have 7 stocks that make up 30% of the index, it's hard to even figure out what the rest of the index is even doing. because you have these mega caps that are moving the whole thing all by themselves. It doesn't happen as much in the Dow, and that's what part of why I think why the Dow numbers not as high, because it's obviously the calculation's totally different, and they do it very, very differently. But with any cap weighted index, you could have 470 stocks that are down for the year, and everybody's going, well, yeah, but S&P's up 12. Like, isn't that a good thing? Yeah, but it depends on what you own.
Well, and we talked about that previously last year at one point when the S&P was up like 17% and the Dow was up like 4%. You know, when you take out those 7 stocks, and it's the S&P was up only around 6, and so it's like, yeah, you're overly weighted in those 7 companies that have performed due to the AI push.
Yes.
Yeah.
So that's what's driving the markets. It's still been the AI stuff.
And some of these names have come back in a big way. Even much more than the index has come up, and it's almost not even traceable unless you have an account that has that specific stock, and you're like, wow, that's really, really done well, because overall the market or overall the indexes haven't done as well as as some of these individuals, and the flip side of that is haven't done as poorly as some of these individuals, because some of the stocks are down tremendously, and again, very stable type of businesses. If you take energy businesses, we're still at pretty high levels in terms of what oil costs, and you wouldn't know by looking at the oil stocks. Energy stocks have not knocked it out of the park. They're not even keeping up with the base commodity growth, which is again strange, because they take that base commodity in, they do all this fancy stuff to it and add all this money to it and then sell it, and you go, yeah, but that's not a good business. We need to be buying
all tech,
this over here.
all AI.
So it's fascinating.